Your money-making broadcast starts now. Good evening, Canada. Today is June 2nd, Tuesday. Here are the top stories moving the markets. While the US tech giants saw some sudden volatility today, the broader market sentiment remains incredibly bullish, with the Dow hitting new record highs. We are diving deep into why a sudden dip in AI leaders might actually be the buying opportunity of the month for Canadian portfolios. Big Story 1, let us start with the heavy hitters. Today we saw a fascinating divergence in the US markets that directly impacts Canadian tech exposure and sentiment. Microsoft and Alphabet both saw sharp declines, dropping 4.17% and 3.86% respectively. Now for the average investor, a 4% drop in a Titan looks like a red flag, but the JAVIS analysis tells a different story. This was not a structural failure or a change in fundamental business health, it was a classic case of AI capital expenditure fatigue. Investors simply took profits after a massive run. JAVIS categorized this as a dip without bad news, which triggered an aggressive buying execution. In fact, our system deployed over $14,000 into CRM. For Canadian investors, this is a reminder that volatility in the Nasdaq often creates entry points for high-quality assets. When you see the VIX drop from 16.15 to 15.77, it tells us that the fear is evaporating. For Canadian investors with US tech exposure through ETFs like ZQQ, this correction creates opportunity. The Nasdaq recovered strongly from early lows. Those who sold in panic missed the afternoon bounce. JAVIS deployed over $14,000 into CRM during the dip. This demonstrates that with 79.4% cash, the key is precision timing. The JAVIS perspective here is aligned with the legendary contrarian approach, buying when others are momentarily spooked. We are seeing the S&P 500 hold firmly at 7,609.78. And the Dow hitting a fresh all-time high at 51,307.79. This suggests that value is returning to the market, providing a stable backdrop for those of us holding diversified Canadian and US assets. Big Story 2, turning our attention to the broader economic machinery, the JOLTS job openings report released at 10 a.m. Eastern was a critical win for the bulls. The data showed remarkable resilience in the professional services sector, which is the backbone of the modern economy. Why does this matter for a Canadian investor? Because the Canadian economy is deeply intertwined with US labor health. When the US labor market remains strong without overheating into hyperinflation, it creates a Goldilocks scenario for the Bank of Canada. On the Canadian front, the Bank of Canada signals dovish leans amid domestic softness. A resilient US labor market provides a supportive export environment. Free cash flow yields on the TSX remain attractive in railway, energy, and financial sectors. Canadian Pacific Kansas City outperforms as a defensive railway play. We are currently on day 41 of a bull market. Historically, these cycles last between 42 to 49 days, meaning we are in the final third of the typical expansion. However, with both ISM and JOLTS now confirming the economic resilience, this cycle has strong potential to extend beyond the average. The Dalio framework continues to prove itself accurate in mapping these macro transitions. For the TSX heavy portfolios, this means commodity demand and industrial activity should remain supported. Big Story 3, the sector rotation story that is emerging today deserves special attention for Canadian investors. While the tech-heavy Nasdaq barely moved, the Dow surged 0.45% to a new record, and the small-cap Russell 2000 jumped 0.93%. This is exactly the kind of broadening that Canadian portfolios benefit from, given our market's heavy weighting in financials, energy, and materials. When money flows out of pure tech momentum and into value and small caps, the TSX composite tends to outperform. Broadcom surged 4.7% today on AI semiconductor demand, while Cisco Systems hit our strategic exit target at $128, delivering a 33.8% gain. The key takeaway for tonight is that the market is shifting from momentum-driven to fundamentally driven. Tomorrow's ADP employment report and ISM services PMI will be the next critical catalysts, and IWM's action today suggests institutional money is already positioning for a positive outcome. For Canadian investors specifically, the rotation into value stocks is a welcome development. The TSX Composite Index, weighted heavily toward financials and energy, tends to outperform during periods when value leads growth. Canadian banks are entering their third quarter earnings season with healthy net interest margins, while energy producers benefit from stable crude prices near $90 per barrel. The Canadian dollar's recent weakness against the greenback also provides a tailwind for TSX-listed companies with significant U.S. revenue exposure, such as Canadian Pacific Kansas City and Shopify. Looking at the individual portfolio names, Broadcom continues to be the standout performer, closing at $481.57 for a 4.7% gain on the day. The AI semiconductor demand story is intact, and the current 11.12% gain on our 6-share position provides a comfortable cushion. The strategic partial sale of 4 shares at $476.12 earlier in the session was well-timed, locking in 9.9% profit while maintaining exposure for further upside. On the bond market front, the 10-year Treasury yield remains stable at 4.437%, a decline of 0.04 basis points. This is a favorable environment for equities, as it suggests the bond market is not anticipating aggressive rate hikes. The Bank of Canada will take note of this stability as it considers its own rate path. Lower bond yields generally support higher equity valuations, especially for growth-oriented positions like our CRM and Broadcom holdings. To summarize today from a Canadian perspective, this was a textbook example of why diversification across asset classes and geographies matters. The JOLTS data provided the catalyst, but the resilience of TSX-listed defensive names and the cash-heavy portfolio ensured we could participate in the upside without taking excessive risk. The 79.4% cash allocation is not bearishness but optionality. When opportunity appears, we deploy capital. When uncertainty rises, we hold cash. This disciplined approach has generated a 7.77% total return since inception. The bottom line for Canadian investors is clear. The bull market has fundamental support from labor data, the rotation into value stocks is benefiting TSX sectors, and maintaining 79.4% cash provides the flexibility to act when opportunities arise. Tomorrow's ADP data will be the next critical data point in determining whether we deploy more capital or remain defensive. The strategy remains disciplined: follow the data, manage risk, and let winners run. Tomorrow's ADP and ISM data will determine the next move. Stay disciplined and watch the data. To wrap up today's session, we have seen a market that is fundamentally strong despite a momentary stumble from the AI leaders. The Dow's new high and the JOLTS positive data confirm that the bull run is still very much alive. Now, let us get into the JAVIS recommended for stock lineup for your portfolio. First, for the safe type play, the global investment legend John Templeton would suggest expanding your position in Canadian Pacific Kansas City, ticker CP.TO, currently trading around $122.67. The rationale here is based on its low volatility and its role as a defensive anchor. JAVIS identifies a target entry below $123 for 8 to 10 shares to balance out tech-heavy risk. For the balance type, the growth and value expert Peter Lynch would favor Salesforce at $200.84. We are currently holding 30 shares here. The stock has a clear target of $225, and the recent dip provided a perfect safety margin for a company that is dominating the enterprise AI cloud space. For the growth type, the world's leading innovation fund manager Kathy would point toward Broadcom at $481.57. With a current return of 11.12% in our holdings, the demand for AI semiconductors remains explosive. JAVIS recommends holding current positions and looking to add more if the price dips toward $450. Finally, for the low-cost or speculative type, the father of value investing Benjamin Graham would keep a close watch on SoFi Technologies at $17.74. The thesis here is a recovery in consumer lending cycles and the democratization of finance. A re-entry point around $16.50 offers an attractive risk-reward setup for those with patience. From a risk management perspective, the portfolio maintains a 79.4% cash position, providing ample flexibility. The stop loss for our current holdings are set conservatively: Broadcom at $450 and CRM at $190. This ensures downside protection while allowing the winning positions to run. Tomorrow's ADP data will determine whether we deploy more capital or stay defensive. One final thought on risk management. The portfolio currently has 73.6% of equity exposure concentrated in a few tech names including CRM. While the JOLTS confirmation supports this positioning, we are actively looking to diversify through CP.TO additions. The stop-loss framework is clear: CRM at $190. These levels ensure we capture gains while limiting downside in case of a sudden reversal. Subscribe for daily Canadian market insights. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.